Hi everyone, welcome to Be Different for Success. Today we'll be talking about a bubble. What is a bubble? A stock market bubble is a period of growth in stock prices followed by a fall. Typically, prices rise quickly and significantly, growing far beyond their previous value in a short period of time. When they fall, they do so quickly and often below the starting value. A stock market bubble can affect either the market as a whole or specific sectors, such as within individual industries or geographic regions. They typically occur when investors overvalue stocks, either misjudging the value of the underlying companies or trading based on criteria unrelated to that value. For example, a stock market bubble often forms when traders enter a self-sustaining cycle of growth. People buy certain stocks, they drive the prices of those stocks up. Other traders may see that growth and buy as well, hoping to profit off the gains. Eventually, traders aren't buying the given stocks because they think the company is worth owning at that price. They're buying in hopes of selling while the price is still high. This leads to a cycle of trading based on criteria that has nothing to do with the fundamentals of the companies being traded. If this cycle goes on too long, it can profoundly overvalue the underlying assets, creating a stock market bubble that will eventually burst. How a bubble works. An economic bubble occurs anytime that the price of a good rises far above the item's real value. Bubbles are typically attributed to a change in investor behavior, although what causes this change in behavior is debated. Bubbles in equity markets and economies cause resources to be transferred to all areas of rapid growth. At the end of a bubble, resources are moved again, causing prices to deflate. The Japanese economy experienced a bubble in the 1980s after the country's banks were partially deregulated. This caused a huge surge in the prices of real estate and stock prices. The dot-com boom, also called the dot-com bubble, was a stock market bubble in the late 1990s. It was characterized by excessive speculation in internet-related companies. During the dot-com boom, people bought technology stocks at high prices, believing they could sell them at a higher price, until confidence was lost and a large market correction occurred. We can identify 5 stages in a typical credit cycle which help to explain some of the patterns of a bubble. Number 1. Displacement. This stage takes place when investors start to notice a new paradigm, like a new product or technology or historically low interest rates. This can basically be anything that gets their attention. Number 2. Boom. Prices start to rise. Then they get even more momentum as more investors enter the market. This sets up the stage for the boom. There is an overall sense of failing to jump in, causing even more people to start buying assets. Number 3. Euphoria. When euphoria hits and asset prices skyrocket, it could be said that caution on the part of investors is mostly thrown out the window. Number 4. Profit-taking. Figuring out when the bubble will burst isn't easy. Once a bubble has burst, it will not inflate again. But anyone who can identify the early warning signs will make money by selling off positions. Number 5. Panic. Asset prices change course and drop. Investors want to liquidate them at any price. Asset prices decline as supply outshines demand. Bubbles versus growth. The key difference between a stock market bubble and economic growth is the series of incentives driving prices. In the stock market, growth is marked by trading based on underlying business fundamentals. The price of a stock should approximately reflect the value of owning that particular company. Stock prices reflect not just a company's net assets, but also an investor's best judgment about the company's business plan, corporate leadership, position in the market, and anticipated profits. When trading is driven by these fundamentals, it will typically lead prices to rise in a stable pattern that we term growth. A growing market will not pop like a bubble because ultimately the assets have inherent value. During a sell-off, traders have as much incentive to hold on to their stocks as to unload them. This causes selling to hit a natural floor and disrupts the negative feedback loop that characterize the second stage of a stock market bubble. Bubbles are not the same thing. As discussed, when a stock market bubble forms, it is because investors have bought stocks based on criteria other than the value of the underlying asset. Often, this can be as simple as short-term enthusiasm. A category of investment can seem exciting, driving traders to make emotional purchases that they otherwise wouldn't. Or it relies on bad information, such as during the 2008 housing crisis when rating agencies identified some prime mortgage assets as high-quality investments. Regardless of the reason, the essential aspect of a stock market bubble is that the basis of that trading can go away. Enthusiasm can wane. That information corrects itself. Most often, people chasing ever higher profits will see the growth falter. When that happens, they no longer have any reason to hold on to their stocks. The selling begins and the stock market bubble pops. Examples of bubbles. Recent history includes two very consequential bubbles: the dot-com bubble of the 1990s and the housing bubble between 2007 and 2008. However, the first recorded speculative bubble, which occurred in Holland from 1634 to 1637, provides an illustrative lesson that applies to the modern day. Tulip mania. While it may seem absurd to suggest that a flower could bring down a whole economy, that is exactly what happened in Holland in the early 1600s. The tulip bulb trade initially started by accident. A botanist bought tulip bulbs from Constantinople and planted them for his own scientific research. Neighbors then stole the bulbs and began selling them. The wealthy began to collect some of the rarer varieties as a luxury good. As their demand increased, the prices of bulbs surged. Some rare varieties of tulips commanded astronomical prices. Bulbs were traded for anything with a store of value, including homes and acreage. At its peak, tulip mania had created such a frenzy that fortunes were made overnight. The creation of a futures exchange, where tulips were bought and sold through contracts with no actual delivery, fueled the speculative pricing. The bubble burst when a seller arranged a big purchase with a buyer and the buyer failed to show. At this point, it was clear that price increases were unsustainable. This created a panic that spiraled throughout Europe, driving the worth of any tulip bulb down to a tiny fraction of its recent price. Dutch authorities stepped in to calm the panic by allowing contract holders to be freed from their contracts for 10% of the contract value. In the end, fortunes were lost by noblemen and laymen alike. Dot-com bubble. The dot-com bubble was characterized by a rise in equity markets that was fueled by investments in internet and technology-based companies. It grew out of a combination of speculative investing and the overabundance of venture capital going into startup companies. Investors started to pour money into internet startups in the 1990s, with the express hope that they would be profitable. As technology advanced and the internet started to be commercialized, startup companies in the internet and technology sector helped fuel the surge in the stock market that began in 1995. The subsequent bubble was formed by cheap money and easy capital. Many of these companies barely generated any profits or even a significant product. Regardless, they were able to offer initial public offerings. Their stock prices saw incredible highs, creating a frenzy among interested investors. But as the market peaked, panic among investors ensued. This led to about a 10% loss in the stock market. The capital that was once easy to obtain started to dry up. Companies with millions in market capitalization became worthless in a very short amount of time. As the year 2001 ended, a good portion of the public dot-com companies had folded. U.S. housing bubble. The U.S. housing bubble was a real estate bubble that affected more than half of the United States in the mid-2000s. It was partially the result of the dot-com bubble. As the markets began to crash, values in real estate started to rise. At the same time, the demand for home ownership started to grow at almost alarming levels. Interest rates started to decline. A concurrent force was a lenient approach on the part of lenders. This meant that almost anyone could become a homeowner. Banks reduced their requirements to borrow and started to lower their interest rates. Adjustable rate mortgages became a favorite, with low introductory rates and refinancing options within 3 to 5 years. Many people started to buy homes, and some people flipped them for profits. But when the stock market began to rise again, interest rates also started to rise. For homeowners with adjustable rate mortgages, their mortgages started to refinance at higher rates. The value of these homes took a nosedive, which triggered a sell-off in mortgage-backed securities. This eventually led to an environment that resulted in millions of dollars in mortgage defaults. Thanks for watching this video. I hope you liked it. Please click the thumbs up and write your personal tips in the comments below. Thank you for your support. And don't forget to subscribe to the channel if you want to hear more from us. See you in the next video.